of the day-to-day issues that we're confronting with the situation this administration's in, the gravity of the war, the concern what's going on in Paris. These are some devastating issues. I'm not denying any of those, but I really think, again, I'm using a little bit of the page of the SVB book. We were all convinced after SVB that a massive credit tightening was going to happen in the economy, and we missed it. And the strength of this economy, the strength of the consumer, the CapEx cycle, M&A, those are very powerful drivers.
We appreciate the constructive outlook. More from Jim in just a moment. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. In a primetime address, President Trump saying the U.S. is very close to completing its military objectives in Iran and vowing to hit the nation, quote, extremely hard over the next 2 to 3 weeks. Still, the speech lacked announcements and most notably a precise timeline for an exit. President Trump also saying in the address, other countries need to take the lead on reopening the Strait of Hormuz. The president saying the U.S. does not need the oil exported through the critical waterway and that the nations who depend on it, quote, go in and take it. And the headquarters of Goldman Sachs in Paris was placed under police surveillance last night following bomb threats believed to be from an Iranian group. The threats come just days after a bombing attempt was foiled near the Bank of America in the French capital, city telling its Paris and Frankfurt employees to work remotely as a precaution.
Yahara, thank you. They are concerning headlines. We'll keep tracking that story for you throughout this morning. Up next on the program, turning up the pressure on Iran.
We are forced back to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. When this conflict is over, the Strait will open up naturally.
Up next, we'll catch up with Bloomberg's Tyler Kendall. We'll have more from Jim Zelter. Brammer's going to talk to him in the commercial break. By the time that's finished, he'll come back a different man from New York City this morning. Good morning.
What is going to be the consequence of U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
The NFTs have not recovered in the same way that Bitcoin has.
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
This is the future. This is the 21st century economy. The transactions.
Nearly $1 billion of Bitcoin.
The technology.
We need to build a digital Fort Knox. That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
I can thank some work. Everyone.
You've had some concerns.
Yes, I have some concerns. I'm an investor in the world. I have a lot of concerns.
Exactly.
It's not about the little narrow. It's not about the little narrow corner of the world that you guys call private credit. It's much broader. But
Sing well down this morning. Pardon? Have you been annoyed by the coverage in the last few months?
no, I'm not annoyed by it. I think it reminds me of when I was a young high yield trader in the early 90s. And when 1990, when Drexel went and filed, and there was concerns about the high yield asset class, junk bonds, asset class won't survive. It's a Ponzi scheme. There's no credibility here. And I think that if I look back at that time, it was early days of the high yield market and a legitimate asset class. I think this is just growing pains. And as I go back to my first principles, if investors over 15 years were not actually making money, and I see the demographics of the investors need, I'd be, but I see the great benefit of this product.
I've sensed frustration. I've sensed frustration from the asset managers. You have to. I can now. I've got to be honest with you. I can sense the frustration that you've got. I think with some of the coverage over the past few months. What is it about the coverage that's been quite upsetting? The fixation on just BDCs and not the broader asset class. What is it about that's upset you and the team, maybe?
Well, I got to push back on being upset. Like
Over the last few minutes has felt that way.
Okay.
Maybe not aimed directly at us, but certainly
Yeah.
the coverage of your world.
Well, I think that a lot because of the proliferation of the analysis in every corner of the environment we work in right now, of the analysis in every corner of the environment we work in right now. I think that's why I had my message about taking a step back. I do think when you look at the growth of the US economy's banking system in the world, we have the leading banks that are well-run organizations that have done an amazing job, and the return on equity and their impact in the US economy is profound. You also have a backdrop of economic growth that is unmatched around the globe. And I don't think it's any surprise that the advent of pushing out the risk in the banking system, the benefit of securitization, the benefit of CLO mutual funds today were very, very forward thinking and able to buy SpaceX several years ago. And so SpaceX is part of their portfolio, a small portion. There's probably not a clearly defined marking process on how they all mark their SpaceX equity because of employee sales, whether it's monthly, quarterly, whatever it is. But just because the marking process may be inconsistent, that shouldn't stop them from buying a great American company that they're going to do very, very well on. And so that's why I think we're sort of missing the plot about, I've talked on this show in the past about Berkshire Hathaway, about half of their portfolio being in private companies. And so I do think the whole idea of the public-private convergence, the broader portfolio approach, where the market's going in terms of these massive capex, that's where I think we've sort of lost the plot a little bit. And again, I'm not in the newspaper business, but I do think that I know what sells headlines. And I think the methodical, robust growth of the US economy, the role of the public-private convergence, the strength and breadth of our financing, that's really the bigger story here.
Clearly, there are people who want to belittle or demean this industry because they feel like either they've been left behind or they want to suppress prices so they can get in and buy. And I just wonder, from your perspective, are you seeing this as an opportunity to get more aggressive, considering that there have been some discounted assets, there are some weaker hands, and a lot of people are worried, including myself?
Well, unfortunately, I would say two things. In my 41 years in the industry and the 20 years at Apollo, whenever there's been any kind of dislocation, we've been fortunate enough between the breadth and the discipline and the capital we have to end up in a better spot. That's number one. The second is, I would say, is the headlines have been much more profound and loud than the activity. There really isn't a lot of assets that are for sale that have widened out dramatically. The high grade index is where it's been. The high yield index has really been pretty tight. There's been a variety of financings done. Look what JP Morgan did on EA Sports. They did a massive IG crossover financing. The high yield and loan market's been pretty strong. So there's been a great excitement about putting this massive amount of capital to work. That's the business we're in. We really have not seen the vast majority of assets coming to marketplace that people have talked about. So, we have a lot of liquidity. We got 125 billion of capital and liquidity ready to put in the market in our platform. But It will be active and I'll talk about it on the several times I'm back here the rest of the year.
Final question,
Yes, sir.
Texas or Florida?
You know, we want to, we love New York. New York has been our home for a long time and we're going to maintain a massive presence in New York.
Or loved by New York?
You know, New York is a very dynamic place that will always attract a lot of best and the brightest of young folks. But we want to make sure, if we think about our company between New York, Des Moines, El Segundo, we want to make sure we have a spot to create growth and innovation. And we'll see what the process leads us to.
Let's go for a walk together.
Sounds
Keep
great.
that in mind. Jim Zalter, good to see you soon.
Believe it.
Thank you. Jim Zalter of Apollo Global Management. Jim, this was fun. We appreciate your time.
Always appreciate it.
Thank you very much. A stern defense whose asset class, no doubt expected by many.
Well, and saying that really you haven't seen the actual pain in terms of fire sales or any kind of assets on the market. The broader takeaway to me is the economy is going to be in a plus place in October, September, come when this is in the rearview mirror. And it speaks to some of the upside surprise that we've seen in economic growth. Also speaks to the reason why some people are worried about
Do you
inflation.
remember a long time ago, if you got the tap on the shoulder and you were asked to move outside of the New York office to somewhere else, it felt like punishment. And now it feels like a reward. You mentioned the line for some of these financial institutions.
trade pick, and this is the anniversary of Liberation Day. We're still seeing a fairly wide trade deficit based on imports of goods in the United States.
Okay, stay first. Let's talk about that jobless claims number, 202. That is the right kind of downside surprise. The estimate was 212. So got a rolling. What it might mean for the Federal Reserve in the future. We've been told repeatedly over the past 5 weeks.
whether the inflationary pressure is going to be similar overseas or whether it's actually going to be more, I don't want to use the transitory word, but more transitory, more temporary in nature because of the growth shock aspect that might be dampened by the robust growth in the US.
Yeah, so definitely we have found that it's not an apples and oranges comparison between the US and Europe. Europe does tend to feel the inflationary impact and the second round impact of energy prices to a greater degree than the US does. I mean, we saw that. But again, 2022 is very different from today. In the case of Europe, you know, you don't have that same strong demand, stronger labor markets, that higher starting point on inflation. So there are some parallels from that respect. But yes, they tend to see the stronger second round effects. And you also have to keep in mind the Fed has a dual mandate, employment as well as inflation, whereas the ECB just has the one mandate of inflation, and they target the headline as opposed to the Fed targeting the core. So they are in a slightly, you know, I would say different position. It is possible that the Fed, that the ECB will move to easing policy this year, or sorry, tightening policy. I have to get that right. They might move to tightening policy this year, and that wasn't our base case. But I think, I mean, last I checked, the market was anticipating 2-3 rate hikes by the ECB, and given just the down. And maybe not recession end of year, but it could put that into next year.
Alejandra, appreciate your time responding to that data. Thank you. Alejandra Gondol there of Ned Davis Research, following better than expected economic data in America. Another one, downside surprise on jobless claim. As we always say, the right kind of downside surprise. Check out this news from Blue Owl. Stock is down in the pre-market by something like 8%. Just bear in mind, this name at the end of last year was trading around 15 and now trades around 8. It's been cut in half almost. The stock is down by more than 8%. These headlines from the Bloomberg team just moments ago. 2, private credit funds capping redemptions of 5%. Go through the redemption requests individually for each fund. Investors in the 36 billion Blue Owl Credit Income Fund, one of the industry's largest, asked to pull 21.9% of shares in the 3 months ending March 31, according to an investor letter. As for the other fund, the Blue Owl Technology Income Fund, saw its shareholders asking for 40.7% back, compared with 15.4% just 3 months earlier.
And Blue Owl is going to respond to these redemption requests by limiting it to that 5% cap that some of its other industry peers have been doing, in contrast to earlier allowing a greater portion to be redeemed. The scope of requests for redemptions highlights how Blue Owl really has become sort of the epicenter of a lot of the concerns, given the fact that they invested heavily in the data centers, as well as other technology and other in software sectors that some other people said were a bit riskier. A question here about whether this is a specific issue to a couple of different loans or whether this is an industry-wide issue. Jim Zelter was on moments ago talking about how he sees this as, what was it, noise? Take a walk.
Noise for the broader asset class,
Correct.
I think, is the frustration coming from some of these private credit managers right now.
Because there are people who have behaved in a more disciplined or less risk on kind of way. That said, there's clearly is an issue that some people continue to harp on and see that in the redemption.
Yeah, and the clue might be in the name, Blue Owl Technology Income Fund. And that's why the redemptions there, the number is so much larger, I would imagine. The issue I've got with this brand, we've talked about this a few times over the last month or so. The problem you've got now, knowing they're going to cap redemptions at 5%, that is basically the industry standard. And as Jim said, it was there in black and white ahead of time anyway, that if you want your money back, you're going to put in a much bigger redemption request. So it'd be interesting to me what the source of the redemptions are, how isolated they are, and a handful of investors who are thinking that way and putting in a bigger number to redeem.
This 40.7% of this Blue Owl Technology Income Corp represent 40% of total investors, or two investors that are putting in significant amounts asking for redemptions. There's also a question at what point some of these funds actually have to start to sell. Because what you have seen is that inflows to some of these funds, not Blue Owl, more broadly in the industry, have been matching roughly what the outflows have been. So you don't have to have the fire sales. At what point do you actually see that pressure valuations of the underlying assets?
Blue Owl down by 8 to 9% so far this morning in the pre-market. Let's give you an update on that and stories elsewhere with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Applications for U.S. unemployment benefits fell last week, suggesting layoffs remain low. Initial claims decreased to 202,000 for the final week of March, shy of what Bloomberg economists were anticipating. These numbers coming ahead of the March payrolls reports set to be released tomorrow at 8:30 a.m. Eastern. We'll see you here. Blue Owl is limiting redemptions at 5% for two of its private credit funds following a massive surge in withdrawal requests. Investor letters revealing shareholders tried to pull 22% of shares from its credit income fund and 41% of shares from its technology income fund. The firm saying the caps are necessary to balance the interests of all shareholders. And the headquarters of Goldman Sachs in Paris was placed under police surveillance last night following bomb threats believed to be from an Iranian group. The threats come just days after a bombing attempt was foiled near the office of Bank of America in the French capital. City telling its Paris and Frankfurt employees to work remotely as a precaution. That's your Bloomberg brief, John.
Yahara, thank you. Thank you for the update. Up next on the program, Osman Kwan of Wells Fargo warning prolonged war limits potential upside. Plus, Danny's going to be back. She's got your morning movers. Blue Owl capping redemptions from two private credit funds. That name down by 9% in the pre-market. there is so much uncertainty. What the market is not paying enough attention is the persistence of the shock, even if the war ends in 3 or 4 weeks. It's not just about the war is over, it's about normalizing the flow from the strait. Lower growth, higher inflation. The question is, how much lower, how much higher? That was Claudia Irigoyen there of Bank of America on the outlook for inflation, for growth, for the global economy, and what central banks might do, might not do in the future. The stores this morning look like this as we count you down to the opening bell. Equity futures near session lows. We're down by 1.4% on the S&P. On the Nasdaq, we're down by 1.8%. With some morning movers, some single names. Danny Berger has more. Hey, Danny.
Hey, John, it's shaping up to be an especially painful session for Blue Owl. Stunning redemption requests for two of their BDCs. We were talking about it before the break. One of their tech-focused ones, 41%. The other one, 22%. They are gating the funds, only allowing 5% to come out, as is the standard for their prospectus. Blue Owl does point out that 90% of investors said that they're sticking with the fund. So that 10%, it was really concentrated, the outflows. But again, these numbers are stunning. Some of the bigger numbers we've heard, Oaktree, for example, 8.5% was their redemption request, which, by the way, Matt and I will be speaking to the co-CEO in about 2 hours time of Oaktree. But still, these are big numbers. It has the market worried. Blue Owl down almost another 10%. It's already lost 65% this stock since its peak. Elsewhere, we're looking at the impact of higher oil prices and generally negative risk sentiment this morning. WTI up as much as 12%. Chevron, Exxon, Occidental Petroleum, all the oil majors undo some of their losses over the past 2 days and post up gains as high as nearly 4% in the case of Oxy. The flip side of this are those that will have to pay for higher energy costs, and the airlines continue to be the poster children for this. The American based carriers down at least 4% this morning. In the case of Delta and United, that's 4 1/3%. Of course, the woes even more acute for international, European, and Asian airlines, looking at higher ticket prices, but still the pain clearly expressing itself this morning, John.
Hey, Danny, thank you. Thank you very much. Danny's going to guide you through to the opening bell in about 10 minutes' time alongside Matt Miller, so look out for that. The pain for the airlines, think about the month they were having before this war started, the guidance they were offering, really strong numbers they'd seen in the underlying business, and then this, bang, different story.
20 to 30% of their total costs suddenly increased by more than 50% with jet fuel now in short supply in places like Europe. How do they pass this along to consumers? Will they tolerate higher prices? That is what we're going to be looking for in the earnings season.
Things have changed for the team over at Wells Fargo. Osun Kwon cutting his year-end price target on the S&P to 7,300 from 7,800, writing this. Other than a firm resolution, we don't see many upside catalysts and see the setup skewed more negatively for equities. Osun joins us now for more. Osun, good morning.
That's right.
Obviously, weren't expecting the war. Not many people were. Things have changed. But typically, you see Wall Street wait. Not married to their forecast.
They are going to be okay with it because I think both Washington and the Fed want to inflate out of this deficit issues through inflation, basically. So if they're okay with 3%, and look at what's happening in Japan. I mean, that's the perfect example of the debasement cycle, which is basically translating into rates ripping, FX collapsing, and stocks are going higher, actually. So, if something like that happens in the US, then I think equities are still going to work, at least in dollar terms. Maybe not in gold, but in dollar terms.
At what point, at what levels do yields become a constraining factor on the multiples on equities? And I'm not just talking about the front end, which is more controlled by central banks, but more 10-year denominations and the borrowing costs there.
Yeah, I think it depends on what's driving rates higher. If rates are being driven by higher inflation and a hawkish Fed, then that's negative for multiples. If it's being driven by a good economy then I don't necessarily think that's bearish for equities because earnings are going to be offset that impact.
Do you think that there's going to be the same leadership in this construct as there was before the Iran war?
So heading into this year, we were getting more bullish on cyclicals, commodities. Commodities was our top sectors heading into this year. Yeah, thank you. We were more cautious on tech, but with this event, I mean, what this did was it at least put a dent on the growth outlook that people were getting really bullish into. And the biggest driver of that bullish outlook was A, the restocking cycle, which I think is going to continue, but also B, the one big beautiful bill, the tax return, which is going to get wiped out basically. The thing is, I think the economy is going to be okay because the cost of living that's spread out over the next 12 months. Whereas one big beautiful bill, that's happening today. People are collecting their tax returns today. So that's going to be a cushion over the next 6 months at least. So I think the economy is going to be okay. But at the end of the day, this is a K-shaped wipe because the bottom 40%, they lose right away because they weren't getting that much from the tax return anyway. Whereas the top 20%, even over the next 12 months, they are still going to benefit by about $1,500. So I think this is a K-shaped wipe.
I was saying, it's good to see you. Thanks for the update. We appreciate it. It's a moving target, I know, and things are moving pretty quickly. I was in Kwon there of Wells Fargo. We're getting closer and closer to a long weekend, and you just wonder where we'll be when we come out the other side.
Long weekend? What are you talking about? It's not going to be a long weekend for us. We're going to be here tomorrow, but that's the reason why how many people are trying to de-risk ahead of what is a long weekend for most people.
I like what Austin said there. This one big beautiful bill, all of that money, that tax refund the president talked about last night, how much of that is just going to your local gas station for most consumers?
3 days for the president where the market will be largely closed. True build-up continues to build. Back and forth in terms of the community.
Take a bit of time to get
Yeah, 400 on the first trade.
quality is a big deal.
I think now 900
It's not
lost
an
there.
instantaneous thing, but it's not also a fight.
Down
You
about
have to build a new plan from scratch.
500.
of, software loans. Bringing Goldman Sachs chief U.S. equity strategist Ben Snyder. And before we get to, the war in Iran and the horrible month that March was, and the fact that Thursday seems to be the worst day for equities, what's your take on the private equity drama? Does it really matter for the wider market, for the wider economy?
The good news is so far, we don't think it's a systemic risk for the economy. The bad news is if you talk to our analysts covering these stocks, they don't expect the headlines to change anytime soon, which means the kind of dynamic we're seeing in the market today probably continues, and it's hard to step in and buy those companies.
I've seen kind of this thesis put forward of prior crises. When you want to, it's, the whole sell what you can, not what you want to, that if people are trying to sell out of an illiquid fund, they eventually move up the proverbial food chain, and maybe that gets to equities too, and they just start selling that. Is there any evidence that that's happening at all?
I've seen a little bit of reduction in equity investor positioning, but so far I would call it broad.
Morning and welcome to the
So
Thursday
what is
Open.
happening with this pattern that we're seeing, and it's not just S&P, but mainly, it gets bid up.
Pre-markets, we gained 0.5% on gold on our first year, and we lost 1% there, so we're negative 0.5% for today so far. Gold is, Nasdaq is
So one result of that is if you look at the market,
swung back
with a very
up.
close inverse correlation to oil, trading with very close correlation to prediction markets. And that means as you were saying earlier,
SPX is
when you're heading into
above the 50% level, and the
but news flow is going to
VWAP.
just makes practical sense to reduce exposure.
How much though have investors just overall gotten really close to the ground because of the volatility? Is this a market that you can be active in at the moment, unless you're, maybe trying to do a short-term quant sort of trend following type strategy?
The strategy we've seen for many of our clients is, I think,
Nasdaq's rotating back down.
the difficulty of predicting geopolitics, and instead extend your investment horizon. Ask yourself, where can I have conviction?
I can get below the 50% level here
Most
for some shorts on the Nasdaq.
geopolitics or private.
Gold is trying to swing back up.
And so if we look at the most popular trades and some of the most successful parts of the market, even during the conflict, they remain the revenue and earnings beneficiaries of the hundreds of billions of dollars of AI capex.
Worries about software. The Strait of Hormuz is closed. The price of oil has been doubled. Why is the market so sanguine? I mean, that's a fantastic outcome. S&P off 4% amidst all those worries.
One underappreciated dynamic that's happened during the last few weeks is as prices have declined, earnings estimates have continued to move higher, in large part because of that tailwind from capex that I was just mentioning. So for example, if you look at these sectors most exposed to the energy shock, the energy sector and the consumer sectors, they account for about 20% of S&P 500 earnings. That's half the contribution from technology. So for investors, although the headlines are being dominated by geopolitics, it makes sense that the primary focus is on that tech investment spend.
By the way, just the counter to this, to play devil's advocate, this doesn't come from me. It comes from someone much smarter than me, Neil Dunna of RenMat, sending this note at the top of the hour, basically saying that the shock to gasoline prices works out to $120 billion. That's about 0.5 percentage points of disposable income. He goes on to say, what seems out of place right now is the fact that earnings estimates for publicly traded companies have generally been rising. I get that energy exposed companies maybe deserve a bit of a shock, but what about consumer exposed companies? If all of a sudden your income gets this hit from the increased amount that you're spending on gasoline?
We're about to head into the earnings season in a couple of weeks. My expectation is we will see some downward revisions to consumer earnings. From an economic perspective, our economists have lowered their expectations for real consumer income and spending. I think that's very reasonable. But keep in mind, we're starting from a very elevated place, in part because of the tax refunds that are coming through right now. So it is a reduction in the outlook, but I don't think it's the kind of reduction that should lead us to really panic about the fundamental outlook right now.
What do you buy in a down market like this? I mean, what have you been excited about in March that's losing a lot of value? You watch your multiples. I'm sure you have an awesome dashboard on your Bloomberg. What are you excited about picking up?
So for us, the key strategy is, as I mentioned earlier, find a place you have conviction in the earnings outlook, where now perhaps valuations are lower, and even better,
if the earnings outlook has been strengthened by the recent conflict. And one place that checks all those boxes for us is solar energy and other parts of the energy infrastructure complex. Right? Because of AI and data center power demand, this has been an attractive theme for years. And now, very likely, because of the conflict, we're going to see much more investment in energy supply and resilience. That includes solar pipelines, other parts of the complex.
And we're gonna have to leave it there. Thank you so much for joining us. I hope your weekend does start at the end of the day today. Ben Snyder, US Equity Strategist, Goldman Sachs. Let's get a quick check on your markets about 9 minutes into your trading day, and we're heading for quite the negative start to the trading session. We're down 1.33%. That means we undo the past phase of market gains, although we, a little bit back and forth on that after the president's address yesterday. The gainers, it will come as no surprise, leading the pack in terms of points added to this S&P. It is the oil majors, Exxon and Chevron, adding 2.4 and 1.4 points to the S&P 500. Some consumer staple names, so also a safety trade. On the downside, as goes sentiment, so too does the Mag 7. NVIDIA, Apple, Broadcom, Amazon, Apple, Tesla, Meta, all having a very, very bad, no good start to the day. NVIDIA racing 10 points from the S&P, which is now currently down 92 points. Tesla having some of its own issues. Matt is not interested in it, but they did have miss on their first quarter deliveries. Meta and Alphabet also have their own thing going on with continued scrutiny from governments looking at the individual sectors and how we're rounding out the week. Energy back at the top of the pile, alongside, as I mentioned, consumer staples. Again, one of the dynamics, just to point out, is that at the start of this conflict, staples and utilities were selling off because of positioning issues. So maybe we work through some of that. Now you can get back to a very classic type of risk on, risk off trade, where energy, staples, utilities does well at the bottom of the pile, consumer discretionary, and infotech. Matt.
Just when you thought to get back to a very classic risk on, risk off trade.
Wait, no, I'm saying it is one.
I
It is
know.
one now.
I know, but I'm just saying, like, something will
Oh,
happen.
yeah, probably.
Right?
I'm sure
There'll
you're
be a basis trade blow up.
Yeah, I probably ruined it all. I realize.
Coming up, Tesla's deliveries may be in a new normal as sales growth slows down compared to recent years. And they're also facing increased competition from the likes of Toyota. We'll talk more about this stock next. This is Bloomberg Open Interest. Our player is back to take a look under the hood of the business of Formula One. Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
Can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'd still be driving some.
Probably very fast. This season, we're along for the ride.
Thousands of American Marines are heading to the Middle East.
Not participate.
There's a very good chance we're gonna end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage. Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
To the minute reporting. The report has been hit.
Since struck the U.S.
And
Embassy.
the analysis you
The
need.
United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Trading day is about to start.
You're already looking for that egg.
European Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom Wigan. This is your opening trade.
Only on Bloomberg. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zavasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Shares of Tesla extending losses. The EV giant delivered 350,000 cars last quarter, missing estimates of 372,000. Let's discuss with Bloomberg Tech co-host Ed Ludlow. He happens to be at the Kennedy Space Center following the launch of Artemis 2. We will talk about the rocket for show, Ed, but I want to talk first about Tesla's dwindling car business. I've heard they also have a lot in inventory. What's up with sales?
Yeah, I mean, it's the second consecutive quarter that the deliveries number has missed estimates, but there is still this large portion of the investor base, right, that sees Tesla's core car business being completely divorced from how the street values the stock, right, which is a future predicated on artificial intelligence, humanoid robotics, and robo-taxis. The production number also came in for the quarter far above estimates, which is kind of interesting. You know, Tesla have been due to start serial production of the Cybercab in the month of April. Maybe they pulled forward on that. They're ending the S and X permanently. Maybe there was a sprint finish to build some in the hopes that that inventory would be worked through. But the stock is down either way quite significantly, right? In a down market where as soon as the headlines hit, it dropped. And so that's something to take into account for sure.
And what about competition for Tesla? Matt was pointing out to me a story that the team did about Toyota expanding its lineup in a way that could really pose a challenge to some of Tesla's cars.
Yeah, I mean, generally speaking, though, the electric vehicle market is still having a tough time of it in Western markets like the United States and Europe. And remember, in Europe in particular, Matt knows full well, many of the OEMs in Europe have many more models. They offer a wider variety of battery electric vehicle at very different price points. And the criticism of Tesla is it has a very narrow range of vehicles that it offers. And so it doesn't resonate with all corners of the market. That's just not where the story is right now. And like, I think, you know,
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. I'm Tim Stennebeck in New York. Coming up, OpenAI closes one of the biggest fund.
Women fit.
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong.
President Trump dashing hopes for de-escalation with Iran, threatening to attack the nation's electric plants if a deal is not made. Oil edges higher after the president's address fails to offer a clear strategy on the Strait of Hormuz, saying it would open naturally after the conflict ends. And a journey out of this world, NASA's crew of astronauts launches into space, kicking off a trip taking them closer to the lunar surface than anyone has been in more than 50 years. Well, it's just gone 8 a.m. across the Emirates. I'm Jemana Bersachi in Dubai, and I think many people in the region probably would have woken up early to listen to President Trump's national address. What we learned was not necessarily new. I think there were some hopes out there that maybe he could be announcing a ceasefire of some sort or a winding down of military operations. He did indicate that the war is going to go on for another 2 to 3 weeks, despite the many military successes that he listed. And also, once again, leaving the Strait of Hormuz for others to sort out. So on the back of that, perhaps not the reaction, not the speech that many in the market were looking for or hoping for. The reaction in market pretty negative this morning. Asia Pacific, the handover, you can see MSCI Asia Pacific down 2.1%. So we saw things turning south shortly after that speech came out around 5 a.m. Dubai time over here. Over the course of the last few hours, we have been in risk off territory. S&P futures, take a look there, down 1.2%. So comparing some of the gains that we've seen over the course of the last couple of trading days, when I would say there's perhaps a lot of optimism being priced in that somehow we were getting to the end of this war, things have changed in the last couple of hours, as you can see. And then oil, the one release valve that we've been talking about, back up again, almost at $107 a barrel, up 5.6% this morning. So whatever Trump said did not ease investors' concerns about constriction, physical supply disruptions that are hitting the energy markets. Brent once again edging higher, up almost 5.6% this morning. And then the USD also benefiting today, up 0.3%. And again, what we're seeing is traditional flight to quality, money going into safe havens, the USD benefiting this morning. But let's do a deeper dive on how some of these Asian markets are faring as well. Winnie Su is in our Hong Kong studio. Winnie, walk us through it and how things changed around the time of President Trump's address.
Yeah, morning, Jemana. We've been really talking to traders throughout the whole morning, and the overwhelming kind of sense that we've been getting is that sense of disappointment. They walked into the speech expecting some sort of clarity or a declared victory, but instead walked out with more worries of potential strikes on Iranian facilities, and hence you're seeing oil prices higher, weighing on Asian stocks now actually making session lows down about 2%, and leading losses today, you can see again South Korea's Kospi index down more than 4%, erasing half of its gains from yesterday. So that overall stronger dollar you just mentioned also weighing on Asian currencies. But now we've got these expectations for supply disruption to last, further inflationary concerns, and potential further slowdown in global growth. That is also weighing on bonds as well. And hence you're seeing Japan's 10-year yield here up about 7 basis points. Also coming after some weak demand from the auction just now. Back to you, Jemana.
Winnie, thank you so much. And also, just to draw the distinction, over the course of this, well, it's now the 4 days of the week, what you have seen is US markets track positive territory, European markets track positive territory, but not the case for Asian markets. They're still tracking negative for the week. So something to think about there. But let's go back to the top story overnight. President Trump has used his primetime address on the Iran war to say the conflict is very close to completion. But he also warned the U.S. plans to launch fresh attacks within the next 2 to 3 weeks.
We are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong. In the meantime, discussions are ongoing. Regime change was not our goal. We never said regime change, but regime change has occurred because of all of their original leaders' death.
Joining us now is Bloomberg's breaking news editor in Istanbul, Patrick Sykes, and our politics editor, Laura. Laura, I'm going to start with you. I guess, if anyone was hoping for a winding down of operations, the language, the rhetoric from President Trump seems to suggest that this is going to go on for another 2 to 3 weeks. What did we learn from his address tonight?
We really got less clarity in this speech than what we had gotten in previous statements that he's made in recent days. He suggested that the U.S. would really be amping up attacks over the next 2 to 3 weeks, but he didn't say that he was going to end the war after that period. He said that the end was close and that he sees this winding down, but he didn't give any firm timeline there, which is a little bit different from what we heard from him just a couple days ago, where he said that the war would be over in 2 to 3 weeks. He also didn't provide any new justification for the war, what goals he was looking for. And particularly when it came to the Strait of Hormuz, he said that that was going to be up to allies, that they needed to gain courage and go take the strait themselves. This comes really, just hours before Keir Starmer and the U.S. is convening leaders from about 35 countries to discuss what diplomatic, military, and other options there are for a non-U.S. led coalition to go about reopening the strait. That has sort of emerged in just the past day or so. The U.S. was specifically not invited to that, with both European allies and allies in the Gulf, sort of seeing an opening for them to come up with a plan. Acknowledging that Trump is not going to help them and perhaps might be detrimental to a process there.
Laura, thank you. So Patrick, I'm guessing because it's early hours in the morning, you don't have an official or even unofficial response yet out of Iran. But of note, the Iranian president actually penned an open letter to the American public yesterday. What was at the crux of that letter?
Yeah, that's right. We still haven't had a direct response. What we do have is this letter from Masoud Pezeshkian addressed to the American people. It's basically outlining Iran's position in the war, that for them it's a war of self-defense, that they didn't start it, that they're a long-standing civilization and they don't intend to back down. But I think more interestingly, the rhetoric really tries to pick on that division between political leaders in the US who are leading the war and the public in the US, which is largely against the war. Iran knows that this isn't a popular war. It knows that, particularly among Trump's voter base, who supported on the back of promises to not start new conflicts, particularly in the Middle East, it's an unpopular war. And he pointed in particular to petrol prices at the pump, right? A particular point of sensitivity there. He knows that there's elections coming up in the US. So I think really just trying to point to that division in public opinion in the US and make it even more uncomfortable for the leadership.
And the timing of that was interesting because it came after a Truth Social post in which the U.S. president referred to Pezeshkian as the new regime president. But of course, he did exist under the former supreme leader as well. I guess one of the questions that people are still asking now is who is actually calling the shots right now in Iran? If it's not Pezeshkian, then who is making some of these decisions about military, about nuclear, about negotiations with the US? Where does it come from?
Yeah, it's worth saying in general, even in times of peace, the presidency in Iran is not an institution with all that much political power on issues like this, on national security and so on. It's more about domestic policy, the economy, and that kind of thing. The key institutions and individuals to watch would be things like the Supreme National Security Council. The leader of that, Ali Larijani, was recently killed in an airstrike, and his replacement, Zoltad, is a particular hardliner, comes straight from the Revolutionary Guard ranks. We know that institution is overseeing whatever exchange of messages is going on between the US and Iran. So they're one to watch. The other individual, I think, would be Ghalibaf, the Speaker of Parliament. In many countries, that's not an institution with particular power. But in Iran, that gives him a place on some of the important security councils, like the one I mentioned. And we know that he's been important, particularly increasingly important since the June war last year.
Yeah, well, his posts on X would suggest he's also a keen watcher of financial markets. Patrick Sykes, thank you so much, and Laura Davison, thank you for breaking down the address for us. Let's turn back to markets now. Asian stocks have tumbled as oil prices climb after President Trump's address dampened hopes for a swift resolution to the Iran war. Joining us now is Deepak Mehra, chief economist at the Commercial Bank of Dubai. I guess what the last couple of days have shown us, Deepak, is that it's really difficult to take more than you know, it's what
Yes, I got a fucking.
the headlines that are coming through in these markets.
Wow.
I was hoping for a resolution, did not get that this morning.
It's a rough one on NASDAQ.
Good morning, Joanna. Absolutely.
Still able to get 0.5%, so we're back to break even.
Before they get better. And clearly the markets are unable to manage this uncertainty. And you can see wild reactions in the markets on a daily basis. So this level of volatility that we're seeing in oil or even in rates, where the market started pricing in rate hikes from the Fed and from other central banks, was quite interesting to see. And it clearly shows that markets are climbing a wall of one
Actually is above the 50% level.
block, which is
And that's why markets are driving back up now.
Yeah, I mean, it's difficult to stay on top of the headlines, and as somebody who works in the news, you write in your notes that the energy shock of today is different from the energy shock of 2022. One of the key distinctions here is that interest rates today are a lot higher than they were. They were very accommodative around the energy shock of 2022. How do you think that that is going to affect where we go from here in terms of the ultimate inflationary impact?
Yes, so on the face of it, it looks inflationary, and that's what the market was thinking. But it's a very different environment. In 2022, when Russia invaded Ukraine, we had interest rates close to zero, and fiscal policy as well was highly accommodative. So obviously that was a concoction built for higher inflation, and the Fed had to act on it. Today, things are very different. Over the last 18 to 24 months, the US economy has been slowing down gradually. Labor market has weakened very significantly. Wage inflation has eased. And so therefore today, when energy prices go higher and energy consumption being inelastic, in the short term, people still need to fill up their gas and still need to cook at homes and heat their homes. Consumers will be forced to cut down on other discretionary spending, which means it's like an additional tax on them. And that would then lead to a growth and an economic growth crisis more than an inflationary crisis. So I think that's how we are looking at it, that this could lead to a severe economic slowdown rather than an inflationary bout. And that is why the Fed is still likely to cut rates this year. I won't be surprised if we get 2 rate cuts, but at least 1 rate cut is what I am penciling in for about September.
Interesting. The thing is that the US, from a pure energy standpoint, is a lot more independent than the rest of the world. That's why you're seeing it, much bigger hits and government responses out of Asian economies, out of European economies. Why then do you think the US economy is going to feel such a growth hit?
Oh, the US economy has been slowing down previously. The labor market is weakening. There are structural issues behind that. We know about the K-shaped economy in the US, where the bottom 50% who don't own equities or homes are already under pressure. So I think it will hit growth because those are the consumers under pressure, already reeling with higher interest rates, weakening job market, and so on. And now this comes as an additional burden on them. And therefore, this is a growth scare and not so much of an inflation scare.
Deepak, at the top of the show, I was noting that US markets have actually outperformed other markets around the world. As long as this war continues, do you expect that phenomenon to continue as well, to persist?
Yes, I think US has appeared as a safe haven across asset classes, Jemana. In fact, you look at US dollar, that has been the safe haven of choice, not even gold, not even the yen. If you look at US treasuries, they have outperformed the other government bonds. And then, of course, US equities, they have fallen much European or international or emerging market equities have done. So US overall across asset classes has been a safe haven, will continue to be a safe haven because of its energy independence, because it has growth drivers which other nations in the world do not have, i.e. AI and innovation. And so hence, if this war drags on, we will see more flows towards the US and US dollar treasuries that equities will benefit.
Deepak, always good to have you on. Deepak Mehra, Chief Economist at the Commercial Bank of Dubai, joining us today. Now, for a look at some of the other stories we're following, the Trump administration is said to be planning tariffs on drug makers that have not struck deals guaranteeing low prices in the US. Sources say companies that don't have agreements with the administration will be subject to 100% tariffs. President Trump has been threatening tariffs on the pharmaceutical industry to cut drug prices for American patients. The Trump administration is also reportedly preparing to overhaul its steel and aluminium tariff policy. The Wall Street Journal says officials are considering a 25% tariff rate on finished products made with imported steel and aluminium. This would replace the current system, which imposes a 50% duty only on the value of the steel or aluminium used in a product. And still ahead, President Trump threatens to exit NATO, but European allies are skeptical the US will actually leave the alliance. The latest coming up, this is Bloomberg.
There's no silver bullet, and I'm the great beneficiary of 40 years of scars and successes, and I can go back home because there's not much I haven't seen in this business.
Watch Hard Lessons, a new series from Morgan Stanley.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Welcome back to Horizons Middle East and Africa. I'm Jelena Bersachi in Dubai. President Trump has renewed threats to leave NATO. While European allies are skeptical the US will actually exit the alliance, they still fear Trump may be eroding it at a precarious moment.
And I think it's a strength for the West. It's something we need never to neglect, is the fact that we are together, we are committed by bonds. And so we need to, there are always tensions. That's not the first time, but we need to solve this as united allies.
Let's bring in Bloomberg East Asia government editor John Herskovitz. John, is there a real risk of the US leaving NATO right now?
We have the rhetoric that's heating up. Trump has said that he's considering removing the U.S. from NATO. He's shown dissatisfaction with it, called it a paper tiger. This has been going on for years. We also saw Secretary of State Mark Rubio had said it's time to question the value of NATO. This comes in the wake of administration frustration with NATO members not supplying military hardware to help secure the Strait of Hormuz, blocking some access to bases in Europe for U.S. military for use in the war on Iran. But we need to separate the rhetoric from the actuality. When Marco Rubio was a senator, he sponsored legislation which has now become law, which makes it rather difficult for the U.S. to withdraw from NATO. It requires acts of Congress for which there probably aren't the votes for this to actually happen. But the real worry for Europe is that the U.S. could erode NATO from within, withdraw its ambassador, not be there for the Article 5 mutual defense clause, the key of NATO. And also there are worries about whether the U.S. will live up to its commitment of the nuclear umbrella, using its nuclear arsenal to help protect nations in NATO. There are only 2 NATO members with nuclear arsenals, Britain and France. Their arsenals are, they're significant, but they pale in comparison to what Russia has, what the US has, and what China has. So all of these are in consideration. There are worries there. The rhetoric is hot, but the actuality is rather different.
Yeah, really interesting context there on Secretary of State Marco Rubio. I will say everyone was focused on his national address yesterday. people thought he might reference NATO, but there was no explicit reference to NATO. Is there anything that stood out to you from the speech, a message perhaps to some of his European allies or allies in the region?
Yeah, I think he was speaking to NATO members and also to countries in Japan, countries in Asia, saying that they should come in and get their own oil from the Strait of Hormuz, that the U.S. is done, and that they are responsible for what they need to get from this. Now, the U.S. just doesn't get a lot of oil and resources, oil and gas from the Strait of Hormuz. Countries in Asia, Japan, South Korea, China rely on it quite a bit. So I think this is kind of an extension of the frustration that he had that countries in NATO and in Asia, allies in Asia, are not helping his war effort, and saying that the U.S. has done its job in defeating Iran's navy. Now it's your turn to get your leases for your own use. Kind of the transactional nature of the Trump presidency. So NATO wasn't mentioned, but a lot of NATO members and also allies in Japan, our allies in Asia, were referencing Trump's remarks.
Yeah, Mark Rutte, the NATO Secretary General, does enjoy a good relationship with President Trump. I think that's been widely covered. But beyond him, I mean, how worried are the rest of NATO members about the real possibility of the U.S. trying to leave or disrupt from within, to use your language?
I think that the worries are there and they're substantial. We saw this going on with threats to take Greenland earlier this year. And the nature of the alliance, which has served an enormous purpose in securing Europe, Western Europe in the post-World War II period, is at stake. I mean, the basic tenets of the Article 5, mutual defense, the nuclear umbrella, and the ability of sharing intelligence, doing military drills with the U.S., having the support of the U.S. military when looking at threats from Russia, it's really concerning to Europe what may happen if the U.S. does decide to find ways to erode the relationship from within. The U.S. actually leaving is another matter, but the threat of erosion is there.
John, thank you so much. John Herskovitz, Bloomberg's East Asia government editor. Now, NASA astronauts have blasted off on a 10-day mission around the moon, marking humanity's return to the lunar neighborhood for the first time in more than 50 years. The U.S. and China are racing to put humans back on the moon, with NASA working to build a lunar base. Bloomberg Tech co-anchor Ed Ludlow reports from the Kennedy Space Center in Florida.
4, 3, 2, 1. Booster ignition. That was the moment that NASA sent astronauts back toward the moon for the first time in more than 50 years. Artemis 2 is a dress rehearsal, first for NASA's Space Launch System, or SLS, developed by Boeing, which generated almost 9 million pounds of thrust and it lifted off the Kennedy Space Center, Launch Complex 39B here in Florida. Initially, there's this 2-day orbit of the Earth at different altitudes, practicing burns, practicing manual control of the Orion spacecraft before a translunar injection. That then puts the crew on a slingshot around the far side of the moon, 250,000 miles of distance, a total round trip of 685,000 miles, at 1 point 4,000 miles from the moon's surface. And in that time,
both gold and NASDAQ,
practicing maneuvers,
SPS all went
craft communication
toward value.
Because ultimately,
Now we need to swing back above the VWAP.
to the moon's surface.
Opportunity here.
That is America.
It's going up.
And it's been an expensive
Target
$6 billion per launch.
VOC level there.
$93 billion program cost. And it's a race against China.
It's
They have
current
their own
range.
ambitions to land on the moon. They've stated 2030.
So with 33
Artemis
points.
2 are expected to splash down on the west coast of the United States in 10 days' time. This is Ed Ludlow for Bloomberg News at Kennedy Space Center in Florida.
Well, a more upbeat story for the show today. All right, coming up, the emerging markets whipsaw as the Iran war drives volatility. We'll discuss what lies ahead with Luis Costa, head of emerging market strategy at Citi. That is coming up next. This is Bloomberg.
The best trend in furniture right now is modular seating. Start small and add more over time, or go big from the start. If you're looking for variety, customization, and style, check out all the modular.
Alana Callaway here at Capital Subaru of Greensboro. Your connection to a massive collection of new Subaru models priced for less. We're always committed to giving you the most competitive offers available. Plus, when you trade in or sell, we'll all
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong.
President Trump dashing hopes for de-escalation with Iran, threatening to attack the nation's electric plants if a deal is not made. Oil edges higher after the president's address fails to offer a clear strategy on the Strait of Hormuz, saying it would open naturally after the conflict ends. This is Horizons Middle East and Africa. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersetchi in Dubai. I was just thinking, it's been a couple of hours since President Trump delivered that national address. And if you had to distill it down to a couple of words that people are going to remember from the speech, it would be, we're going to take them back to the Stone Age. So that is what you need to know if you're just tuning into the program now, suggesting that military operations are going to go on for another 2 to 3 weeks. But I think there's a real threat of what might happen in terms of military escalation over the coming few days and possibly weeks as well. So as you can imagine, markets are not reacting that well this morning. The handover from Asia Pacific down 2.1%. We'll get into more details in just a moment. S&P futures now down 1.2%. I will say, though, for the week, we're still tracking positive. Remember, the last couple of days, markets have been trading more upbeat on the possibility of a resolution to this war. So let's see how things evolve over the coming days. And obviously, we're entering into a holiday period as well around Easter. Brent 107.50 is where we are right now, up 6.4%. So we really spiked up once Trump started speaking. And that has just accelerated in the last couple of hours. So inching back to $110 a barrel again. And then the USD also benefiting this morning from being a safe haven. We're seeing money going into the greenback, up 0.3% for the Bloomberg US dollar. But let's talk more about some of the price action in Asia. Winnie Su is standing by for us, Winnie.
Anna, as you mentioned, it really is overall a sense of disappointment in markets that we're not getting close to any de-escalation of the war situation. And here you're looking at oil prices higher and hence pressuring the MSCI Asia index now down more than 2% around session lows. Now, as you mentioned, we do have a couple markets closed tomorrow in Asia that includes Hong Kong, Singapore, and hence for now we are headed for 5 weeks of decline for Asian stocks, and that's the longest since November 2024. Leading losses today, you've got Kospi here down about 4%. But when you look across the board, actually, Chinese stocks doing fairly well compared to the other benchmarks. And China has been seen as this market that's been quite insulated amid this war. And also that's coming as they have these oil supplies and also the strength in renewable energy. Now you flip the board and also take a look cross asset because bonds, currencies also under pressure. The stronger dollar weighing on Asia's currencies with that gauge now down about 0.1%. Japanese yen back to the 115.9 level against the dollar. When it comes to the Japanese 10-year yield here, up about 8 basis points. And that is also coming after the auction, seeing the weakest demand since May on these concerns around inflation. And for now, we are pricing in the Bank of Japan to hike rates in April at about 70%. Back to you, Jemana.
Winnie, thank you so much. Winnie Su in Hong Kong. Well, emerging markets are seeing sharp swings as investors react to shifting signals on the Iran wars. Stocks remain volatile after a tough month, with oil prices and global growth concerns continuing to cloud the outlook. For more, we're now joined by Luis Costa, head of emerging market strategy at Citi. Luis, good morning to you. Is it fair to say that the longer this goes on for, the worse prospects look for emerging market economies, even if there are some winners out there?
Absolutely, absolutely. It's not only the P&L shock, it's the fact that the current energy pinch, this is squeeze, if we are talking about a longer longevity, will change central banks' policy action, right? I mean, we might be talking about hikes in the future. Previously compared to a previous environment of, inflation converging to the target. So, and obviously, let's not forget about the growth drag, especially for the emerging Europe. What does that mean in terms of potentially generating a stagflationary environment in some of these jurisdictions? So it does create a lot of uncertainty on both ends for EM equities and for EM fixed income as well.
The other thing, Louis, that I picked up on from just speaking to various people in the market is there seems to be a perception that, let's say, in the case that the war winds down in the next 24 hours, which we understand is not going to happen, there's an assumption that everything will just return back to normal in a fairly quick manner. But clearly, as long as the fate of the Straits remains unresolved, as long as we're sitting on a substantial amount of physical damage and the real geopolitical premium that perhaps investors are going to be pricing into the region, we may not go back to the same environment that we were in before. How does that affect the outlook for emerging markets?
Yeah, that's one of the topics we've been discussing with our clients quite a lot. It's our model case, our base case that we are not returning to pre-conflict energy prices, especially when it comes to oil, right? I mean, at least you could be talking about some sort of a residual geopolitical risk, especially if you consider that, if you assume that there's no regime change in Iran or not even regime tweak. Right. So at the end, they will need to get paid. So and in the whole geopolitical anatomy of the region, there will be, we believe, some sort of residual geopolitical premium there. So that will stay, and which means a lot, or again, for the emerging market central banks. So we are not going back to low 70s in Brent. We are probably sticking around. Our model case somewhere between 85 and $100. And which changes quite a lot the way central banks might see monetary policy going forward. We do believe that can be some hikes. We don't think central banks will rush to hike, but we heard even from the ECB, right? I mean, they cannot discard the possibility of reaction on the monetary policy side over the next 6 months. And I do believe that some central banks will probably need to act.
Yeah, and it's not just the energy shock, Louis, but also you talk in your report about the terms of trade story encapsulating obviously more than just energy. And for many of these economies that tend to be quite resources heavy dependent, what are going to be the knock-on effects of the second derivatives shocks that are coming through from the energy shock? And that could be, demand destruction on metals, for example.
Yeah, and it's very interesting because some of these economies like South Africa, even Australia outside EM, previous to the conflict, we were pricing terms of trade paradise, right? I mean, gold up, metal complexes up, energy values, energy prices down. So in both sides of the balance sheet, these economies, they were actually benefiting from the environment. And here we are now in a squeeze, both sides of the balance sheet, revenues and cost, which is the energy side, they are squeezing some of the economies. South Africa is a very good example to that. The terms of trade index in South Africa has come down by more than 25% since the peak before the conflict. So, I mean, it's been quite a squeeze, and it's obviously going through the currency as well. So now we investors, analysts, we are actually, scrambling to find out what is the fair value for some of these commodity currencies now.
Yeah. Louis, one final question I want to round up with. I've been talking about the dollar benefiting from its safe haven status, which again is a paradigm shift from where we were for most of 2025. And I wonder if the USD continues to strengthen, whether there's going to be more pressure on local emerging market central banks to do something about the depreciation of their own currencies. Are you expecting more interventions in the coming months?
Well, I mean, so far so good, Jumana. I think that then it's been the reaction. Obviously, it's been an environment of destruction of P&Ls everywhere. But let's be honest. I mean, the performance on the MFX has been quite mild compared to the shocks. For example, we are seeing on the equity space, the shocks in some parts of the. If things get more severe, some central banks might react, which actually re-energizes this theory of potential interest rate hikes, measure interest rate hikes over the next 6 months, if this environment doesn't change substantially in a few months.
Yeah. Okay, Louis, thank you so much. Always good to chat to you. Louis Costa, Head of Emerging Market Strategy at Citi. Mozambique has surprised markets by repaying about $700 million to the IMF ahead of schedule and in full. The move has raised fresh questions about the country's strategy and relationship with the lender. Our Chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. So, okay, interesting development. Why did Mozambique choose to repay the IMF early? What's the thinking behind the move?
Yeah, Jumana, that's really the question a lot of markets participants are asking. We don't have an official statement from the government at this point in time, but the clearest read that we can get is potentially the country is trying to signal a bit of independence and financial independence from the fund. We should note that it had been in quite a difficult position prior to this happening, although it did take most market participants by surprise. We have been hearing that this was potentially a technical hurdle in some of those talks that Mozambique had been having with the IMF. This potentially does clear some of those hurdles, but still, it doesn't mean that everything is all clear moving forward, because we do know that the government is still looking to perhaps start a new program. So yes, potentially this is an effort to reassure investors, but still, we should note that what we heard from Standard Bank is although this potentially could help institutionally, it does potentially drain the country's foreign reserves, especially considering that it wasn't too long ago that the IMF had described the debt as being in distress.
Then what is the read across to Mozambique's ability to secure a new funding program from the IMF now that they've repaid this one?
Sure. Bloomberg reporting is still potentially looking at the fact that this will still be on track for August to have a post-review with the IMF. So that's still on track. But we should still note again, the country had been in debt distress as described by the IMF not too long ago. That was largely due to debt-funded overspending and also delays to some of the LNG projects. And so the read across really is that potentially the IMF is still quite cautious about what this means for the government, especially because a lot of the considerations by the fund are still not addressed. You were just talking to Luis Costa about some of the financing in terms of currencies. The Metical has been something that the IMF has tried to call on the government to let float freely. This is a difficult time, especially considering the implications for what a free-floating Metical could be on citizens. That could cause some unnecessary distress among the citizens. Not just that, there had also been calls to address some of the public spending wage bill. So these are some of the things that are still left unaddressed. And so although we do expect for the government to seek a new program, the questions are, will they be able to, and are they willing to address some of these ambitious reforms that the fund and other multilaterals have called on?
Jen, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent in Johannesburg. Coming up, we're live to Tel Aviv to speak to Redlands University's Mir Javidandar after President Trump's warning of increased attacks over the next 2 to 3 weeks. This is Bloomberg.
When the sawdust settles and the engine roars, the thing you care about is the job well done. But when you get your tools from Harbor Freight, something about the job feels different. Your wallet. Whatever you do it for less at Harbor Freight.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Prime Minister Benjamin Netanyahu says Israeli and U.S. attacks on Iran have eliminated Tehran's abilities to produce nuclear weapons as well as ballistic missiles, removing what he described as 2 existential threats to Israel. The Prime Minister, who is facing corruption charges at home, is looking for a political win, but is he going to get it? Joining us now to discuss is Dr. Mir Javidandar, Iran politics lecturer at Reichman University. A lot to discuss with you. Before we talk about domestic politics within Israel, I do want to go back to Trump's address overnight. And I want to ask you your read on the situation and whether this was Trump prepping the world, perhaps implicitly, indirectly, for an intensification of operations and perhaps even ground combat.
Well, before I answer that question, I would like to have the caveat, please, Jumana, that it's extremely difficult to really predict what President Trump will do. And his statements are very difficult to decipher. It's almost a form of encryption. You need a special decryption software to realize what he's trying to say, because from one day he changes his message to the other. But I think President Trump wants this war to end as soon as possible because of the damages that are being done to the global economy, and also he's standing for re-election. His government is going to be standing in the Congress and the Senate. So it's very difficult for him to get a win and to finish as quickly as possible. And I think he's trying to force the Iranians right now to come to the negotiation table, first and foremost, to open up the Strait of Hormuz, because this is turning out to be a challenge for the global economy, much bigger for China than the US. 37% of China's oil passes through the Strait of Hormuz, or only 7% of the US oil goes through there. But in any case, for President Trump, he sees the price that is being imposed on the global economy. He wants this finished, but he wants this with a result. He wants to walk away with something tangible, which starts with opening up with the Strait of Hormuz, and if he can get it, with Iran agreeing to all these nuclear demands. Whether that will happen, we don't know. But at this time, the infrastructure, the bombing of Iran has started in earnest of its infrastructure. Now they are bombing steel production plants and other governments, important, tangible, and profit-making government businesses in Iran, to force them to accept America's terms.
Okay, so let me ask you this. Can President Trump paint this as a victory if they walk away or the war ends without extracting that enriched uranium stockpile from Iran?
Just leaving it as it is would be looked upon not very favorably, if I can be diplomatic about it. Maybe he'll find a way of getting the IAEA to inspect it, or the IAEA to remove it. But leaving it there would be very dangerous for the state of Israel and for the United States, Jumana. This is not something that he would want to have on his resume. But I also have to say that the Iranians also have a lot of considerations which we must put into this equation. Iran's economy is doing very badly. I mean, yes, Iran is selling more oil now than before the war, which is really a contradiction in terms of what President Trump wanted. But it's going to be very difficult for Iran to get the money from the sale of its oil back to its coffers. Because until now, they tried to use Dubai. There were Iranian front companies that were illegally using Dubai in order to launder money, sanction money back to Iran. But now, after the policy of attacking the United Arab Emirates, I have to say, terrible policy for Iran, and a very costly policy, the UAE is cracking down on this. So it's going to be very much more difficult for Iran to get money back to its economy. And this is also going to put a lot of pressure on the Iranians, because the Iranian rial has been in the free fall beforehand.
Yeah.
And Iran really needs to also end this war with a game. But I think President Trump finds it very difficult to walk away without getting that enriched uranium out.
Yeah, people are very focused on perhaps the political and military aspects, but less so on the economy. And you make a very good point there. I want to ask you about the Israeli Prime Minister's televised address a couple of days ago. And it was interesting that he actually said that Iran doesn't pose an existential threat anymore, and also talked about the military successes that the joint operations have achieved. What did you make of that address?
Well, first and foremost, Jumana, Iran not posing a nuclear threat to Israel anymore. This is not new. This already happened in June. Iran has not enriched any uranium since June 2025, after the 12-day operation by the State of Israel. So Iran already does not, from a nuclear point of view, pose a strategic or existential threat, whichever way you wish to put it. So this is not something new. But regarding the missile program, Jumana, yes, this is a serious threat. The Iranians were trying to build new production lines, which would have enabled them to produce more ballistic missiles, which would have overwhelmed our anti-missile system in Israel, posing a very serious threat to our security. And this is one of the reasons Israel attacked the war and wanted this war. The other reason was also Iran was going to remove some of its missile production capabilities on the ground, thus making it much more difficult to strike. So if we're just focusing on the missile aspect of Iran, the threats posed by Iran, Netanyahu is right. Israel had to do this, and the results from what we know have been significant. But regarding the nuclear program, no. We already knew this since June, Iran cannot enrich.
Right. Mir, always good to chat to you. Thank you so much for coming on. Mir Javidanfar, Iran Politics Lecturer at Reichman University. Now, the Iran war is disrupting global aviation with soaring jet fuel prices, airspace closures, and widespread flight cancellations hitting airlines worldwide. Carriers are being forced to reroute flights, cut capacity, and absorb sharply higher fuel costs, putting pressure on fares and schedules across global networks. For more, we're joined now by Danny Lee, Bloomberg's Asia aviation and transport reporter. Well, this morning we'll be taking a look at where oil prices are up more than 5-6%. Obviously, this has a real impact on airlines. So how are these higher jet fuel prices impacting airlines around the world, not just specifically in the Middle East?
We've already heard from airlines talking about a doubling or more of jet fuel costs. Already, airline CEOs are saying they're having to raise airfares by up to 30%. So they are having to raise fares quite significantly in order to cover the cost, the volatile cost of jet fuel. And so there is a lot of pain out there. There is also airlines who are not protected from fuel hedges. I've heard a little bit about that. The likes of the large American and Chinese carriers and low-cost carriers are not protected. So they're eating up the very volatile cost of jet fuel in full. So there is a lot of pain there. We heard from Malaysia Airlines CEO today saying that they're having to absorb a 140% increase in jet fuel costs. So overall, we are seeing some pain, and with airfares spreading, airfare or demand being dislocated. So far, it seems like passengers are willing to pay higher prices because of that gap left in the Middle East.
And is it reasonable to expect more disruptions to operations, reduced schedules in light of the higher jet fuel prices? What do those dislocations look like from the war?
Yeah, we are seeing actions taken. Airlines, for example, United Airlines has already decided to cut about 5% of its capacity, particularly routes which now are more marginally unprofitable. In places like in Southeast Asia, in Vietnam, where there are risks of jet fuel shortages, we're seeing up to 30% cuts in capacity by domestic airlines. So overall, there is a very concerted effort to try and add capacity if you're a European or an Asian carrier where their demand is because of the Gulf dislocation. But in other parts, you're trying to conserve where it doesn't make sense to fly, cut the flights outright. So there's a bit of a rebalancing going on overall in the aviation industry.
Yeah, makes sense. Danny Lee, thank you so much for your perspectives. And also, good to have you with us live from an airport. I believe you're in Hong Kong airport as well. Good to see. Okay, let's round up the show taking a look at how some key financial markets are responding to President Trump's national address overnight. And you can see that it is a sea of red out there. We've got S&P futures now down 1.3%, NASDAQ down 1.6%. Take a look at European markets, also pointed to open substantially in negative territory, down 2%. And then not just that, but take a look at oil as well. Once Trump started speaking and it became apparent that they were not winding down military operations, and in fact, quite the opposite, you saw this big uptick in prices of some of these key energy indicators.